Good afternoon, everybody, and welcome to this ESRC Festival of Social Science event. My name's Carl Emerson. I'm Deputy Director here at the IFS, and we're very pleased to be participating in this series of seminars. We're very grateful to the Economic and Social Research Council, both for much of the funding they provide to IFS, but also for the fact that they're organising this event. So this is the latest one in a series of IFS events. Today, you're going to hear two of my colleagues talk about student loans in the cost of living crisis. The final one of this series from IFS will be on Thursday at the same time between 1 o'clock and 2 o'clock, which will be on how to tax multinational companies, how to tax mobile capital. So that's an event to tune into on Thursday. So today's event, as I say, is going to be on student loans in the cost of living crisis. We're going to have two of my colleagues speak. First of all, Ben Waltmann's going to present. Then you'll hand over to Kate Ogden, who will then present, and then hand back to Ben Waltmann for a few final slides. Then it'll be time for Q&A, where I will chair those, and Ben and Kate will be here to answer any questions you have on all issues student loan related. To post questions, please use the Slido link, which you should be able to find on the YouTube page or on the IFS website. You can post your questions there. You can also vote for questions that other people have asked that you think are particularly important or interesting. And that's worth doing because I'll naturally focus the questions towards the top of the list when picking what to ask Ben and Kate. So that's all from me until the Q&A session. I will now hand over to Ben to get rolling with the content. Thank you very much.
Hi. So I'm going to talk about student loans and the cost of living crisis, or we are going to talk about student loans and the cost of living crisis. And here's the plan for today. I'm going to talk about briefly what the student loan system is in England and the major reform that has been announced this year. Then Kate is going to talk about students in the cost of living crisis and the kind of government support that is or is not available to them, as well as the impact of high inflation on student loan interest rates. And finally, I'll wrap up with a kind of look at the future of post-18 funding, and in particular cover the government's plan for the so-called lifelong loan entitlement. As Carl said at the end, we should have lots of time for questions. So first of all, the student loan system and the reform this year. So under the current system, higher education funding in England relies almost entirely on student loans. That is actually quite different from other countries where public funding plays a much larger role. So what happens in England is that students take out loans for both tuition fees typically and living costs, so-called maintenance loans, and then they start paying back these loans after they graduate, once their income rises above a certain threshold. Then students repay until the repayment period is over after 30 years, when the remaining loan is written off at no adverse consequences to the graduate. Most graduates, I should say, never earn enough to pay back in full. So that means some of their remaining loan is going to be written off after 30 years, and that remainder is essentially covered by the taxpayer. So the main criticism of this system is that because it involves these write-offs by the taxpayer once these 30 years of repayments are over, it is actually quite expensive for the taxpayer. And the estimate from the Department for Education before these recent reforms was that the taxpayer ended up picking up around half the cost of these loans. So in order to address that, they've announced a major reform this year, which has three key components. The first one is that from the 2023 university entry cohort onwards, the repayment threshold, which at the moment is at £27,000 roughly, is going to be cut to £25,000 per year. and frozen until 2026-27. So in real terms, that threshold is actually going to be substantially less than £25,000 a year in today's money in 2026-27, when that threshold is then going to be increased according to current plans, but it's no longer going to increase with average earnings as was the previous plan, but it's going to increase with RPI inflation, which you might not guess so from the current numbers, but typically we would expect average earnings to rise faster than inflation. And so that is a further cut that's going to be, as time progresses, is going to mean that the threshold is going to be, the difference between what the threshold will actually be and what it would have been under the old system is going to be bigger and bigger over time. Secondly, that's the second major component of the reform. The repayment period, which is currently 30 years, is going to be extended to 40 years. So that means many graduates will be making repayments 40 years after they have graduated, so typically until their 60s. And finally, in more welcome news to students and graduates, the interest rate on student loans will be decreased from currently RPI inflation plus 3% in the maximum to just RPI inflation, which is actually especially for higher earning graduates, that's translates into a substantial cut in the interest rate on student loans. So all of that, I should emphasize, applies from the 2023 university entry cohort onwards. So it doesn't apply to current students or previous graduates. It only applies from people who go to university from next year onwards. So what's the effect of these reforms? Well, perhaps the most striking difference between the current system and that future system is that the share of graduates paying off their loans will go up enormously. So right now, so before the reform, we estimated that around a quarter of students would pay off their loans, and that is set to rise to 3/4 under the new system. And in terms of sort of distributional consequences, what the new system will mean is higher repayments for what we call lower middling earners. So you can think of that as teachers and nurses, and lower repayments for the highest earners, largely because of the cut in the interest rate. So to show you that in a graph, before the reform, the system looked roughly like this. So the poorest graduates at the bottom here would pay hardly anything, and the richest graduates would pay off much more typically than they borrowed in real terms. So above £70,000 actually under the pre-reform system. And now after the reform, it will look like this. So the lowest earning graduates will still be protected, but in the upper half of the distribution, everyone will essentially pay off what they borrowed in real terms. So that means a sort of substantial increase in repayments. You can see the scale here. This is kind of nearly £30,000 for these lower middling earners, as well as a sort of a large cut in the amount people have to repay among the highest earning graduates. And the way that comes about here for the highest earning graduates is largely the lower interest rate, and for the lower middle earning graduates, what really affects them is the lower threshold for repayments and the longer repayment period, because typically these earners won't quite or only just about pay off their loan by the end of those 40 years. So it really matters for them how much they have to repay every year, which is determined by the threshold. Okay, so we're saying this is a leap into the unknown. Basically, it's a radical reform. So as I mentioned earlier, according to the OECD, the UK already has the lowest share of public funding in tertiary education among rich countries, and this is going to lower public funding further. It's unknowable what the effect is going to be on enrollment numbers, but this is a headline from The Guardian, so it is possible that people will opt out of those occupations that don't offer very high earnings, such as teaching or nursing, in response to these higher lifetime payments. What's even more uncertain is the long-run taxpayer cost of the system. So because of this 40-year repayment period, what now matters are repayments in the 2060s, which are basically impossible to predict with any amount of certainty at this point. Also, the repayment threshold going up with inflation instead of earnings means that what matters much more for the system is going to be future earnings growth in terms of how much is going to be repaid. And finally, a lot with the, this kind of very long period of repayments, a lot depends on the value that we attach to future repayments far in the future. So that means sort of accounting considerations play a massive role in assessing the cost of this new system. So just to give you an idea of these accounting issues, so these are kind of all different ways in which one might do the accounting. I'm not going to go into it, but basically how you can read this here is that before reform under this accounting system, which is just using the RPI real value of repayments, we would have estimated that 30% of the loan is going to be picked up by the taxpayer. And now under the new system, our estimate will be 16%, and that's about 6 billion per cohort or 3 billion per cohort. Whereas, there are different accounting systems which give you very different numbers. But perhaps most importantly from the government's point of view is this number, which is the ONS's way of doing that accounting. And as you can see, the gap between the old system and the new system is particularly big under this kind of way of accounting for student loans. And fortunately for the government, that is actually what determines the deficit impact of the reform in the public finance statistics. As you can see, this reform is sort of, as it were, almost as if it were optimized for the government accounting. I should also mention that besides those changes for the 2023 cohort onwards, there are also big changes for past cohorts that have been announced this year. So the repayment threshold has been frozen at £27,000 for 3 years for past cohort. And after that, it will also be increased with RPI inflation rather than average earnings growth. So that is a big cut in the threshold for current students and those who've recently graduated. The effect of that is that the lifetime repayments for the 2022 cohort are going to be more than £10,000 higher than they might have thought when they first enrolled in university. Those with middling earners are going to be hit especially hard, we think, at about £20,000. But on the other hand, that does generate big long-run savings for the taxpayer. So we reckon it's about 5 billion for the 2022 cohort. But again, it's very uncertain. These threshold changes have much less bite with lower growth. So yeah, it's very hard to say what the actual long-run effect is going to be. So in conclusion, on student loans, this reform is going to transform the system from what was essentially a tax on graduates to with some kind of special features for the highest earners to what is now essentially a loan system with some subsidies for the lowest earners. And importantly, those who pay off under the new system are going to repay exactly what they borrowed in RPI real terms, which wasn't the case before. As I said, it's a leap into the unknown. It's unclear what will happen to enrollment. The taxpayer cost is very uncertain. But what we do know is that the student loan system with this reform becomes a lot less progressive in the sense that the highest earners benefit from the reform and lower middling earners lose out. But that being said, future policy is also extremely uncertain. The student loan system changes with government policy, and all of that, what I've shown you, assumes that policy is going to be constant over the next 40 years, while in actual fact, it seems basically certain that policy will change a lot over those decades. With that, I will pass over to my colleague, Kate,
There we go. Thanks, Ben. Hopefully you can see that. So Ben's talked a lot about the long-term outlook for student loans. I want to focus in on the immediate term and what the cost of living crisis means for students. So we've heard a lot in the news about the cost of living crisis, but what do we actually mean by that? In particular, we mean a period of high inflation in which prices for everyday essentials are rising more quickly than people's incomes. That means people's spending power falls and it squeezes living standards. One measure of how quickly prices are rising is consumer price inflation, or CPI, which measures changes in the total cost of an average shopping basket, so of a range of goods and services bought by households. And that basket contains everything from bread and milk to clothes and nights in hotels. And it's weighted by how much households spend on each item. Some level of inflation is normal, even desirable. If we look back to March of last year, we were expecting inflation from then into the long term of around 2% a year. So in each year, we expected prices to be around 2% higher than the same time a year ago. Now, by October of last year, the Office for Budget Responsibility, which produces official forecasts, was expecting slightly higher inflation, peaking at just under 4.5% this spring. Part of that was mechanical because prices were unusually low a year earlier, which was kind of the height of the pandemic, but it also reflected rising global commodity prices and issues in supply chains. By March this year, after the invasion of Ukraine, the OBR expected much higher and more persistent inflation, peaking at close to 9%. And there it's higher gas prices, pushing up people's utility bills and pushing up people's wage demands. That peak was expected to be the highest inflation rate in around 40 years. Now, the Bank of England produced some new forecasts a week ago. And in that most recent forecast, the bank expects inflation to peak at just under 11% this month and to stay elevated for another 2 years. So we're in a period of very fast price rises. And each time we've had new forecasts, prices have risen by more than they were expected to. Now, what does this mean for students? Most obviously, like for everyone else, it means their living costs are rising. On average, students' largest cost is the rent, which accounts for around 40% of spending. And that's followed by spending on supermarket shops, on groceries, and on spending on household bills, so gas, electricity, internet. It's hard to say precisely what price rises students are likely to see. Depends on exactly what each student spends, what that kind of basket increases by. But at least for some who might have agreed their rental contracts far in advance, so if you've been asked to set up where you're going to live a year in the future, they might be a bit protected on the rent side, at least this academic year. Now, equally important is where students' income comes from. Around 60% of students report having a part-time job during term time, and those that do work seem to work an average of around 10 hours a week, although some will work significantly more or significantly less than that. Many receive some support from their families, or manage to earn more through working during the holidays, or they have savings that they can draw on. But on average, around half of students' income comes from maintenance loans. As Ben mentioned, as well as loans to cover tuition fees, the government offers maintenance loans to help students with living costs while they're studying. Around 9 in 10 students takes out a maintenance loan, and the maximum amount a student is entitled to borrow for their living costs depends on 2 things: where they live during term time and their household earnings, which usually means their parents' income. So here, let's look at the maximum loan that someone will be entitled to for their living costs. With household income, so typically parental earnings across the bottom. Now, someone living at home during term time with household income of less than 25,000 would be entitled to just over £8,000 each year. The household income is more, that entitlement is tapered away until somebody whose parents are earning more than 59,000 gets just under £4,000 a year. Now, students living away from home get more. And students are living away from home and going to university in London get more still, so to reflect their higher living costs. Now, implicit in this system is the idea that students, wherever they live, will be receiving some support from their families, and that those whose families have more income will be able to provide them with more support. Now, importantly, each year, those maximum entitlements to loans increase, and they increase in line with the forecast for the retail price index excluding mortgage interest. So that's just another measure of inflation, of price rises. Now, that should mean that as prices rise, loan entitlements also rise. So the real value of support for students is maintained over time. So let's look at what year-on-year changes have been in those maintenance loan entitlements and what actual inflation has been over the last few years. Between 2017 and 2020, loan entitlements increased by around 3% each year. And in fact, CPI turned out to be a bit lower than that. So maintenance support was increasing more quickly than consumer prices. Now, last year, maintenance loan entitlements increased by 3.1%, and this year by 2.1%. If government sticks with the typical policy, then maintenance support next academic year will rise in cash terms by 1.8%. Now, we know these rises haven't kept up with inflation the last few years. CPI last year was just over 6%, and we're expecting it to be just over 10% this year. So those rises in support are actually real terms cuts. And they're real terms cuts of 3% last year, 7% this year, and possibly another 2% next year if inflation is as predicted by the bank. So inflation coming in higher than expected means that maintenance support has been cut significantly in real terms since 2020. And those past mistakes in inflation forecasts are never corrected. This means support is worth 10% less this year than it was 2 years ago. That's a cut of £960 a year for a low earner living away from home outside London. So for that student, we can see that the real value of their entitlement rose in real terms until 2020, but it's since been cut significantly. Now, another helpful comparison is with how much a student could instead earn if, instead of studying, they spent those hours working at the national minimum wage. So using the expected time students will be studying for, which is 37 hours a week for 30 weeks of term, you can work out what a student would working for those hours would earn on the national minimum wage. That generally tracked those maintenance entitlements until 2020, but since then a gap has emerged. So this academic year, a student would earn more than £1,000 more from working those hours at the national minimum wage than they will get from their maintenance loan entitlement. There is another way in which support has become less generous over time, which is slightly less obvious, and that's that that household earning threshold of 25,000, below which students are entitled to the maximum amount of support, has been frozen at 25,000 since 2008, even as average earnings have risen significantly. If it had instead been increased with average earnings, that threshold would now be £35,000. Now, this means that only around half as many students are entitled to the maximum support now as would be if that threshold hadn't been frozen for the last 14 years. So maintenance support will be much less generous in the past. Where might students turn? I've mentioned that the system assumes students will get some support from their parents. As that threshold of 25,000 has been frozen, the system actually relies on more support from families each year. But rises in their own living costs mean parents might be less able to contribute than they have been in the past. Most students aren't eligible for benefits, with some exceptions for disabled students and those with children. That means most weren't eligible for the £650 cost of living payments, which have been given to low-income households this year. There is support for some people who pay energy bills, and that's particularly to support people with high energy bills this winter. So if a student rents privately and has a contract with an energy supplier, they should get £400 credited to their account between October and March. Importantly, that's £400 per energy bill, so not per student. So if you're renting with a group, it's not £400 each, it's £400 per bill. If bills are included in rent, then the landlord should be passing this discount on. It's really unclear, though, what's going to happen for students who live in halls. There is an alternative scheme from the government, which is intended to catch people who aren't getting the £400 because of how they receive their energy. But it's not clear whether students who live in halls will be eligible to apply for that. So watch this space. I think this means it's quite likely lots of students will be looking for part-time work or trying to increase the hours that they already work. Now, it would take 4 hours of work a week during term time at the national minimum wage to make up for that real terms cut in the maintenance loan since 2020. And that's not an insignificant number of hours, given that students are recommended not to work no more than 15 hours to avoid hurting their studies. Finding holiday work, that might be easier to balance with people's studies, but many students already work over the holidays, so it's not clear how much extra work they'll be able to find. And it's relatively easy at the moment to find work in retail and hospitality, which quite often students work in. But we are expecting unemployment to rise over the coming few years, which might make it harder for students to find those extra hours. Now, of course, universities may also offer their own hardship funds. It's not something we're very well placed to talk about, but if anybody listening is concerned, that's definitely somewhere to ask. Now, the second thing I wanted to talk about was the impact of inflation on students and student loans, which has received a lot of media coverage because inflation affects the interest rate that is applied to student loans. So students borrow initially to cover tuition fees and that maintenance support I've just talked about. And interest is added on to that loan balance from the day you take out the loan. The interest rate depends on RPI, which is another measure of inflation. While you're studying, the interest rate that is applied is RPI plus 3%. And then after you've graduated, it depends on how much you're earning. And it's higher for higher earners. So this year, for somebody who took out a loan, who started studying up to this academic year, their interest rate will be RPI if they are earning less than £27,000. Once you earn more than £49,000, it's RPI plus 3%. And in between, it's on a sliding scale between those. Now, technically, the interest rate is set for an academic year, and it depends on RPI in March of the previous academic year. So the interest rate this September would normally depend on the change in retail prices between March 2021 and March 2022. Now, there are two important things here. Firstly, there's an extra protection in place in case the maximum interest rate was much higher than the average rate available in the commercial market. This cap used to kick in only once the interest rate had exceeded the cap for 3 months, which produced some very strange behaviour, as I'm going to show you. But the government has now fixed this. So we now expect maximum interest rates for the highest earners to be capped at around 7.5%. So let's look at the maximum interest rate charged on a student loan. So for those still studying or who are earning high amounts, would typically be RPI plus 3%. Now, RPI in March this year was 9%, so without a cap, we'd have seen interest rates rise to 12% this academic year, and even higher to 15% next year. Now, using the old government method for capping rates, we would still have seen a rise to 12% for some of this year, but then this kind of strange roller coaster as the caps applied in a slightly difficult technical way over the next few years. But with the government's new improved method, the current interest rate that's being charged, the current maximum interest rate being charged is 6.3%. And we now expect rates to peak at around 7.5% and to follow this much more sensible path. Now, 7% is much less scary than 12% or 15%, but these are still very high rates. This is more than that borrowing costs government, and it's more than the Bank of England base rate, which has been in the news recently and which is relevant for mortgages and for other kinds of borrowing. Importantly, all that I've said applies to borrowers who started university between 2012 and this academic year. For those starting next year, as Ben mentioned, the interest rate will be just RPI. No one will see RPI plus 3%. And for some other borrowers in Scotland, Northern Ireland, or who took out their loans before 2012, the interest rate will instead be the lower of two things, the bank rate plus 1% or RPI. So that will be lower than students under the current English system. Now, there are a few problems with these things. For one, RPI is a bad measure of inflation, and it's gradually being phased out. And for another, all this is quite confusing. And that matters because some students might be put off from studying because they hear scary headlines about high interest rates. But crucially, student loans aren't like other types of borrowing. The interest rate determines how much is added on to the total balance outstanding. But as Ben said, for many people, most people won't, under the old system, many people would not repay the full amount. You only make repayments in months when you're earning over a certain threshold. And the repayments you make don't depend on the amount you still owe, because they're set as a percentage of your earnings over an earnings threshold. So whether you owe £10,000 or £60,000, you'll pay the same amount back each month. The only difference it makes is to how long you make repayments for. So only those people who expect to repay at least the full amount that they originally borrowed will start paying back any of the accrued interest. So for many people in practice, the high interest rate won't make a difference to their repayments. I will now hand back to Ben, who's going to talk. I'll tell him what he can tell you. He's going to talk about the lifelong loan entitlement.
Yes, thank you very much, Kate. So yeah, the final topic for today is what will happen to the post-18 funding system, which includes the student loan system in the medium term, so in the future. And the key kind of policy in this space is called the Lifelong Loan Entitlement, or LLE, that the government is planning. So lifelong loan entitlement is the government's term for the whole system. And that more details on the lifelong loan entitlement have been announced along with the student loans reform that I talked about in the first part earlier this year. And in particular, the key description that we've got from the Department for Education of what this is the following here. From 2025, the lifelong loan entitlement will provide individuals with a loan entitlement to the equivalent of 4 years of post-18 education to use over their lifetime. This kind of sounds simple, but actually is a bit of a puzzling statement for people who know about the current system, because actually learners on nearly all post-18 routes, so all education routes from age 18 onwards, are already entitled to at least 4 years worth of student loans. Yeah, as I sort of already kind of hinted at, this isn't really one policy. It's more of a sort of umbrella term for various ideas on reforming the post-18 student loan system. So what are the central planks of this policy? The first one is to create a unified student finance system. So a student finance system that would cover both higher education, which is what we've talked about for in the presentation so far, as well as further education at an advanced level. That would cover mainly vocational education at a level higher than A-level or equivalent. The second key plank is to make it possible to study for separate modules of courses. So that could be higher education or further education courses, rather than whole degrees, as is currently the case. So it's currently not possible to get a student loan for anything that's less than a year. And that is the idea there, is to change it. And thirdly, relaxing so-called equivalent or lower qualification or ELQ rules, which govern the order in which you can study qualifications at level 4 to 6. So everything above A level essentially and what you can get a loan for. So these are the central planks. They are roughly in the order of what we think is the government's degree of commitment to them. But as we will see, a lot is still unclear regarding of what will actually happen under this banner of the lifelong loan entitlement. So let me go through them one by one. So first, a unified post-18 finance system. What does that mean? So basically, the idea is to extend higher education loans, so tuition fee loans as well as maintenance loans, to qualifying further education courses, and abolish the separate loan system that we have currently for those advanced level further education courses called advanced learner loans, or ALLs. So that is in principle a really good idea, we reckon, because it levels the playing field between higher education and further education, in the sense that further education providers would be able to charge higher fees for these qualifying courses, and further education students on these courses, and that's probably the most important part of this, could get the same living cost support that's currently available for higher education students through these maintenance loans that Kate has talked a lot about. So basically, this kind of policy would level the playing field between higher education and further education in an important way, and that kind of fits with the general kind of emphasis that this government has shown for boosting the prestige and the value of higher vocational education. The second part of this is to limit the loan entitlement to 4 years of post-18 study. That is kind of a bit of a tricky one. So taken literally, it would actually mostly be an entitlement cut, because as I mentioned before, under the current system, most students already have an entitlement to at least 4 years of student loans and thus funded study. So for example, if we take that 4-year limit literally, you could no longer do a further education, an advanced further education qualification after a 4-year degree with a student loan. And you could also no longer switch to get full funding for a 4-year degree after having already started on a different course, which are both things that are currently possible with loan funding in place. So this, just as a sort of illustration, this is from the government consultation, is what these sorts of accounts would look like. So according to the government's plans, so everyone has an entitlement to 4 years worth of funding, which at current higher education tuition fee rates means £37,000. So this is meant to be accessed sort of through the web, as you can see here. And then spending of this on different courses creates a loan for the learner, and the entitlement is basically those 4 years, and that can be spent however the learner sees fit. So what are the outstanding issues with this? Well, one thing is that it's still substantially unclear which courses will be eligible for this unified post-18 funding system. Definitely the kind of what's called higher technical qualifications are going to be eligible. So that's the government's kind of flagship scheme for advanced vocational education. That's kind of what this is all about. Probably all standard undergraduate higher education courses are going to remain eligible for such loans, because they're essentially a continuation of student loans as we know them. But there are kind of questions around things like PGCE, so teacher training courses or integrated master's courses, or indeed courses that take longer than 4 years, which it would seem aren't straightforwardly covered by these rules. And in fact, the government is consulting about what should be done about it. One other thing that seems already quite clear is that other advanced further education courses, so that don't qualify as higher technical qualifications, probably won't be funded. So for those types of qualifications, that would be a funding cut. Finally, the 4-year limit, as I mentioned, does seem to cut entitlements. And so without exemptions, it would actually seem to make lifelong learning harder, which seems to be completely the opposite of the government's intention here. So it seems clear that there will have to be some exemptions, but it's very much not clear what exemptions the government will put in place to avoid that outcome. Okay, second major plank modular provision. So the government is committed to funding separate modules of courses rather than courses or full years. So modules are basically parts of courses that don't in themselves lead to a qualification, but you may get a certificate for it. So for instance, you may be able to do an 8-week course and use maybe 25% of your yearly allowance, or the 25% of the sort of full fees for a year of higher education on it, which may lead to a certificate rather than a full qualification at an advanced level. And then the idea is that those kind of modules can be combined from different providers to then add up to a full qualification. The outstanding questions here is how many providers will offer these modules and how many students are going to sign up for them. With the government's currently trialing so-called short courses, which kind of mirror this kind of, or is a sort of prototype for these modules, and their take-up, from what we know at the moment, seems to be very limited indeed. And the second question is to what extent actually these modules are going to be transferable. So I think it's impossible to say at this stage to what extent different universities will recognize each other's modules so that actually can add up to a whole degree. And finally, I guess there's also a question about whether this is actually a good idea. So on the one hand, having this modular provision clearly provides flexibility for people with caring responsibilities or people with non-traditional career routes, and in that way kind of supports the government's goal of enabling a more flexible learning at an advanced level. On the other hand, there's a danger that we'll see people doing modules for 5, 10, 15 years rather than doing a degree in 3 years. And that sort of dragging out of higher education might actually make it harder to be to succeed for students, and it may seriously reduce people's lifetime earnings because people may work in sort of lower paid jobs for quite a while before they actually are able to finish their qualifications. So that's kind of the danger here. Finally, relaxing ERQ rules. So these equivalent lower qualification rules at the moment mean that students are only eligible for loans when studying courses at a higher level than their highest current qualification. So for instance, if you already have a degree, you're not eligible for a loan for another degree. That's partially relaxed for particular subjects of study. There's a sort of patchwork of rules there. It's really complicated. And the Ogden review, which was the big review of the post-18 education that was commissioned by the previous government, recommended to scrap these rules. That actually seems like a really important part of this whole endeavor, because if the government wants people to retrain, then it seems kind of counterintuitive that we would not give loans for people who are sort of wanting to do that at the same level as a qualification they already hold. So what the government's actual position on this is very unclear from the consultation document on this and everything else that has been released. But from sort of reading between the lines, the default position seems to be no restrictions. So that would be a substantial relaxation according to what the Auger review recommended. But whether that's a good idea is sort of also an open question, I think. On the one hand, it offers flexibility to do degrees in any order that you might want. On the other hand, there might be a danger of a lot of people kind of getting what I've sort of called here recreational qualifications in inverted commas. So basically studying subjects or doing degrees or qualifications because they enjoy doing them rather than because they will get a better job out of them. And obviously, while that might be very nice for the individual, it could seriously raise the cost of the student loan system in future, if to the extent that certainly people on the 2012 to 2022 loans, many people still aren't going to be expected to pay off their loans. So the cost may, in the end up with the government. For this sort of reason, the government seems to be thinking about new restrictions that might replace the these current ELQ rules. So that might be based on age, that you can only do these qualifications up to a certain age. It might be that you will have to do a full course if you do one at the same level, or it might be that there has to be a time lapse since you completed your last qualification before you can do a new one at the same level. Okay, so that's the lifelong loan entitlement as it currently stands. What do we make of this? So as I mentioned, we think the unified post-18 finance system is a good idea. Limiting loans to 4 years, on the other hand, risks serious cuts in entitlements if there are no exemptions. The arguments for and against modularity of loans seem to be pretty fine, and courses seem to be pretty finely balanced, sorry. These ELQ rules seem to be a really crucial part of this agenda, and what is going to happen to them, yet the government seems undecided. So on the whole, a lot seems to be still unclear on how the lifelong loan entitlement will work, but I hope that this has given you at least some idea of what is being planned and how the system might evolve over the longer run. So that's it from me and Kate from the presentation, and now we're looking forward to your questions.
Thank you very much, Ben. Thank you very much, Kate. That was great. So we've heard all about the direction of reform for future students for their repayments. We've heard about inflation and what that might be doing to students at the moment and what it will do to loan repayments. And we've also at the end there from Ben heard about this new idea for how to integrate better and reform the loans available for further and higher education. So do be posting your questions on Slido. We've got lots coming up. And I'll start with the question at the top of the pile, which is from Michael Picken in Glasgow, who perhaps given his location is asking about whether this is all about England. And I think the answer is yes. And to which he follows up with, well, I think he's talking about Ben's presentation and the reforms. So the UK government is making this reform to the English system of higher education finance. What would that do to Scottish finances? Now, actually, this is a devolution question. So I wonder if Kate might have a stab at that with her devolution hat on.
I specialise in English local government, which is not much use for this question, I'm afraid.
Ben, do you know?
But yeah, so I don't know precisely, but it seems to me that all of this is really about England. And yeah, I don't.
Yeah, I mean, in general, if there's less spending on a public service in England, that translates into lower grants coming from Westminster to Scotland, which they can then choose whether they want to cut some spending, not necessarily the same spending, or whether they need to put taxes up to help fill any gap. I don't know whether there's something special about student loan repayments that means they're not treated in the same way as other areas of public spending. But my expectation, it will mean, we're making the system less generous, less taxpayer support in England. It will, in general, I would expect that to mean lower grants going to Scotland, and Scotland will then have to decide how it handles that situation. But it's possible student loans are treated in some different way. So the next question is about the OECD figures, which I think Ben quoted at the start, and asking whether, is it the case that the UK really has a lower share of public funding and tertiary education, or is it a factor of the fact that the OECD doesn't count our big student loan subsidies as part of that spending?
Yeah, so I don't know exactly how the OECD do their figures, I'm afraid, but I don't think that they disregard the student loans. No.
Okay, so we think they are included and captured. And so next one is from Dan, who's talking about Kate's presentation and what's been happening to maintenance loans and the gap between that and the national minimum wage. And essentially is asking, what do you think the government should do about that? How can we avoid that happening if it is something that we want to avoid?
So I guess worth saying that gap is only true, it's only that amount for students who are entitled to that kind of 9,000 figure. So the minimum, the people who have low family earnings and are living away from home outside London, the kind of amount of support people are really entitled to depends a lot on the circumstances. But the trend is still the same, that kind of earnings on the national minimum wage are going up quicker. What do you do about that? So you could increase maintenance support by more than they have been doing. You could correct for past inflation forecast errors. That would make a difference in the short term. I guess it's also perhaps helpful for students that the national living wage is soon expected to apply from the age of 21 instead of 23. So more students will be covered by that higher wage. And that's increasing, that's part of the reason you get that increase in that final year is actually students' potential earnings outside of studying might actually be getting better per hour. So there's a bit of a positive news story on that one there, that actually this gives students maybe more options.
Thank you. So another question here, which is getting into the fairness issue, which is, I guess, pointing out that with these repayment thresholds, with these terms changing after you've taken the loan out, is this not a rather odd way of operating a loan? And is that fair?
Yeah, I mean, it's certainly a rather odd way of operating a loan if you compare it to what a private lender would offer. So usually with the private lender, you would sign up to the repayment terms, and then those repayment terms are what they are. In this case, the kind of terms and conditions for the loan do say that the government can change the parameters. So in a sense, the government is well within their rights to do that. But yes, I agree that it wouldn't be what you would typically expect from a loan. And in fact, it sort of has more of the character of a tax, where that also changes in unexpected ways that you don't know beforehand. Yeah, is that fair to previous generations? I think we generally don't think there's a problem with that for taxes, but here it sort of affects certain people in particular, and the framing of that was very much around loans at the time. So I think my kind of worry about it would be more about the framing as a loan rather than about the fairness in itself.
And I guess, Ben, you made the point about how projecting these costs through to the 2060s is very hard because a lot depends on what's happening to earnings. I guess the lesson from recent years is also a lot depends on what future governments choose to do as well. Yeah,
for sure. I mean, indeed, we might see a future government cancelling these loans entirely. That is within the realms of the possible. Definitely, it's the kind of possibility space is wide open in the sense of what future governments might decide to do.
Thank you. Okay, Kate, so the next question's about the, it was noticeable in your figure on the maintenance loans. There were two reasons, I think, why things might not turn out, why the lines might diverge. One is that we're using CPI to measure household inflation, but the government's using RPIX. And the other is coming from the fact that the government's using a forecast, whereas we're using kind of latest estimates of what numbers look like. I don't know if you happen to know kind of, how important each of those two factors is and whether there's, a more fundamental difference that matters here.
So we'd normally expect that RPI figure to turn out to be higher than CPI, which is why you see those kind of real terms increases up to 2020. I think what's going on next academic year is, so for 2020, from September 2023, what will happen to entitlements is they go up by what the OBR forecast this March just gone for RPIX in Q1 of 2024. So it's partly, it's largely because the government is using this slightly strange thing. They're using quite an old forecast for RPIX. If they used the most recent one, they'd be putting up loans by entitlements by more in 2024. So it's 2023. So it's, they're using an out-of-date forecast, and inflation keeps surprising us on the upside.
Right. So that does also suggest that if they move to using CPI and a more recent measure of CPI, that would make the system more generous in the near term, but actually less generous in the longer term, in expectation at least.
Yes. So if you were concerned to preserve the real value, you might want them to stick with RPI or CPI plus a bit.
Yeah. Okay, so the next question is, this is back to Ben. Looking at the reforms that the government did, what could the government have done instead if it wanted to perhaps hit low earners, low middle earners less hard, and yet still take out the savings that they were, or find the savings they were looking to find? Would that have been, is that possible, or did they go for the only groups they could do within the HE system?
Yeah, I mean, it is very difficult within the constraints of the system as it is. So, you know, if you are going to think of it as a loan, then the only thing you could theoretically do to hit higher earnings more is to put up the interest rate, because these highest earners already pay off their loan. So in a sense, if you fiddle with the repayment threshold or the repayment period, that only kind of affects the speed at which they repay their loans and affects the overall amount rather little, because they pay off with interest either way. So yes, you could have. So the only way to hit the highest earners would be to raise interest rates within this system, which we don't think would have been a good idea. And partly that's because these interest rates are already really high, far above the government's cost of borrowing, which means that as someone who borrows and then sort of repays over their lifetime would repay a lot more than it costs the government to actually fund their student loans. So in the sense, the government is profiting off these high earning students, whereas like high earning students who whose parents might have paid for their education up front would not have made these extra payments. So I think with high interest rates comes a sort of unfairness, and so we previously called for interest rates to be lower, and in fact that is the way the government has gone down, and I think that is right, even though it is regressive. Now, are there other things the government could have done? For sure. I mean, one thing that gets talked about is what's called a graduate tax. So just kind of not conceptualizing it as a loan, but just raising extra taxes from graduates. That has some sort of technical difficulties, but it doesn't seem like it would be impossible. That would also hit higher earners more. But I guess I have, like, there are two sort of other comments on this I have. One is that you know, it's also possible to use the other taxes. You know, hitting the student loan system isn't necessarily the appropriate way to ensure progressivity of the tax and benefit system. So, you know, if the government wanted to hit higher earners, maybe they should just raise taxes on higher earners. That's the first thing. The second thing, which is sort of related to that, is it makes sense in terms of economic choices if people roughly pay for their education as much as it costs to provide it, to the extent that they do make a choice of whether to get that education or not. And we don't want to make a choice that is kind of economically, from a macroeconomic point of view, worth it for the individual to make, and kind of raises overall output and welfare to be not worth making for high earners, because they could have earned nearly as much if they hadn't gone to university.
Thank you very much, Ben. Now at the end of the hour, so thank you very much, both Ben and Kate, for those presentations. All very interesting material. Thanks a lot for everyone who attended this event. As I said at the start, the next one, the final one of this series from IFS, is on Thursday, which is on how to tax footloose capital, so how to tax multinational companies. I hope many of you tune in then. Thank you very much.